Hi, folks. This is Professor B. Um, some of you wrote to me about problem 2-2 in Advanced Accounting Chapter 2. And because it involved a worksheet, it was kind of a lengthy problem. And since we've never really worked on a worksheet before, I thought it'd be smart to share with you this video clip that goes through some of these challenging aspects of the worksheet. We have in problem 2-2 down here a continuation of problem 2-1, which states that on July 1, 2016, Roland Company exchanged 18,000 of its $45 fair value shares for the outstanding shares of Downs Company. In problem 2-2, we simply changed that to saying that the Roland Company, on the same date, exchanged 14,000 of its $45 fair value shares for 16,000 of the outstanding shares of Downs Company. So Roland gave up 14,000 shares, and so when a company issues a common stock, we generally write it at par value, that common stock line, and we can confirm the par value up here. It's $1 for each Roland and each Downs share. So if we're going to issue some shares, we're going to record it like this. And we typically sell common stocks or issue common stocks to raise capital, right? And so we took 14,000 times $45 per share. That's what we would typically receive in cash if we were to issue 14,000 shares of common stock for Roland. The difference, of course, can be chalked up to additional paid in capital, or the book may call it paid in capital in excess of par, whatever. Either way, that amount will be the difference between the par value. So the par value is $1, 14,000 shares were issued. And so the remainder of it must be the additional paid in capital. So here simply we can go that minus this amount to give us an additional paid in capital. So they received a bunch of money. What did they do with this money? They went out and purchased investment in Downs Company, right? And so this then is worth $630,000. And at this point, we don't really care about how many shares we received. We'll deal with what the value was of all of this in the value analysis down below. But for now, I wanted you to have an understanding of what transpired initially. And because here we have a transaction that could have consummated in the same day or the same moment, actually, what we do is we really just delete the cash impact altogether. You'll notice that there's a debit to cash and a credit to cash. So we just eliminate that, right? So let's pretend that we're going to eliminate that. And so then what we're left with is this item here, investment, and this item here, as far as this initial investment is concerned. I wanted to break this down for you mechanically so that you could see why we were issuing common stock for 14,000, and then why were we debiting investment in Downs for 630. It's because we ultimately consummated this deal by this transaction in this journal entry, albeit that it's possible we sold an item. We spent 630,000 in cash, and then we spent that cash to purchase investment, and we just kind of made it a compound entry here. But ultimately, that's what transpired here initially. Right? Is that all? Is that all that occurred on the transaction date? No, there was also some sort of an acquisition price paid by Roland. So Roland paid acquisition cost of $40,000 here. So we need to record that as well as part of the initial investment, and that could simply be an expense entry where we record it as an acquisition expense of some sort and just pay cash for it. That's pretty straightforward. Why don't we add this to the investment cost? Because this is something really that is going to be a period cost, something that we incurred in purchasing this asset. And so at this point, we're not going to consider that in the purchase, just we're going to call that a period cost and move on. I'm going to kind of run through some of this value analysis and D&D analysis just because at this point my focus is on the worksheet, which is the more difficult aspect of this problem. And it seems like a lot of you got the initial first few sections correct. So I'm just going to run through it real quick. So in part B, they tell us that for this investment, for $630,000, they received they received 80% right here, 80% of the company's underlying book value. Okay, so if we purchased 80% of a company for $630,000, then we can uh, calculate what the overall implied value was for that company. And we can do so by simply taking that amount and dividing it by um, 0.8, which represents 80%. So if 80% represents $630,000, then 100,000 must have been 787,500, and that means that 20% of that overall implied value goes to the non-controlling interest. In a value analysis, we typically look at what was paid by the parent, what it implied for the overall value, and then we compare that to the fair value of the net assets of the acquiree, right? So, what are net assets? Net assets are basically current assets plus fixed assets, so pretty much all assets minus liabilities. But they have to give us this information, right? They have to let us know what the fair value was of all of these items, and they do that. They do that here. They tell us that the following fair values were applied to their assets: 70,000, 80, 90, building 150,000, and equipment. So if I were to take all of these fair market values and add them up together, I end up with 490, and I can pretty much just show you the formula here, what I did to end up with that. Why are we not using the book values? Why are we using the fair market values? We're using fair market values because when the parent purchases 80% or any controlling interest in a subsidiary, it's really like a sale occurred. And so when a sale occurs, the new price that was paid for any of the assets becomes the new cost, so to speak, for the new consolidated group. And so, since we are interested in determining the value of this new consolidated group, we need to focus in on the fair market values. And typically, this doesn't present a challenge unless you have book values that are different. So, let's just take a look at the book values that we have here for Downs. 70,000 in other current assets, 70,000 here, 60,000 for inventory. Inventory went up by 20,000. So that is something we're going to have to increase. But for now, let's just take a look at what the book value was and then what the fair book value was. So really, this is the fair value that we need to contend with, and it adds up to be 490. We also recognize that there is a current liability for Downs for $60,000. So I'm going to need to subtract $60,000 here, or just 60 for my simple little calculation. So really the net assets fair market value is 430,000. And that's kind of what we needed to invoke down here in this line. Fair market value of the net assets excluding goodwill. And we're going to determine what the goodwill is in just a second. But if this is a fair market value and this was an implied price by some purchaser, in this case Roland, then what it means that anything over fair market value of the net assets is considered to be goodwill. And so we can compute that simply as a difference between the red and blue here. And then this goodwill we can use down the road to determine what happened with assets, etc. But before we get further, I just want to make sure that you guys are clear on some of these points. That parent, in fact, paid 80% of the company for 630,000. Now we know that the fair value of the net assets they were purchasing was 430,000. 80% of that is their share, right? So we can simply go point 0.8 um, excuse me, zero point 0.8 times this 430 amount, and that should give us a 344. That wouldn't lead us to the correct answer here, but it would lead us to a goodwill of 286, which is, of course, the difference between the two. And we can apply the same formula for the 20% NCI's share. Again, that's zero point 0.2 times the total fair market value of the net assets. And again, the difference between the two is their appreciation over and above fair market value, typically known as goodwill. Why would somebody pay goodwill? Well, if I were going to open up McDonald's, right, I would have to pay goodwill because of exceptional management that they have, or some icon or product that is well recognized over and above their competitors. And so this is how typically goodwill is generated when you sell a business. And in a consolidated group, that's really kind of what happened. You sold 80% of the subsidiary to the parent, and we need to kind of recognize the goodwill inherent in this overall deal. All right, what else do we need to do? Um, this additional amount that we have just determined to be goodwill, um, we also need to determine if there was any appreciation of assets, right? And that's what the D&D schedule does. The determination and distribution schedule allows us to identify items that were increased in value. So the easiest thing to do right now is to just copy this top line, this row 71, onto row 78, because they both speak of the same thing. What is the implied fair value of the subsidiary? And again, it's 787,500 for the overall, 630 for the 80% share, and so on. The next part is relatively straightforward, because what we need to do here is simply we need to identify the book value of the interest that we have acquired. The book value is usually given to us. And I'm going to just go ahead and give myself a split here so it's easier to jump up and down. And so we're down here somewhere, book value of interest acquired. And the book value of interest acquired is really these items right here, right? These are the book values. These are the fair values. So we want to go back to the book values just to see what was in part of that implied price aside from goodwill, because we just determined the goodwill up here. All right. So if you wanted to do that, you'd have to use the D&D schedule, and in it we need to compare the fair value of subsidiary to the book value of the interest acquired. The book value is simply the common stock paid in capital and retained earnings, right? So for Downs, that is 20,000, 180, and 140,000 respectively, and that's down here, right? We add up those amounts. So the overall book value, the total book value of the equity, which is the common stock, the paid in capital plus the retained earnings, is 340,000. I want you to go ahead and copy that across the board here. And you'll see why in just a second, because we're gonna, in the next line, talk about the interest that was acquired out of the 340,000. In other words, Roland acquired, when they paid 630,000, 80% of the subsidiaries' equity, which was 340,000. 80% of that was 270,000. Excuse me, 272,000. Right, so all right, let's go back to the overall implied value, which we computed at 787,500. We realized that the book value of the acquiree was a total of 340,000. The difference between that and that amount comes out to the excess of fair value paid over the book value. We can go ahead and compute these amounts here as well, but for now we're really concerned with the overall value of the company versus the overall book value of the company. And the difference between the two is something that, uh, which is a 447,000 amount, is something we have to determine how that came to be. Well, we already figured out in the previous analysis that the goodwill was 357,000. So, in order to come up with this overall green and orange part, what we need to do is first plug in the goodwill that we've already computed, which was from this cell 357, 500. We simply need to put that down here, copy and paste. Now we need to increase the value of the inventory or adjust the value of any asset here to see if we can come up with the actual 447,500 that was paid over and above the book value, because we need to give credit to where things have improved in value. All right. So out of the 447,500, we know 357,500 belongs to goodwill, and now we also can go back and determine the remainder of these items. I know they're kind of filled out here for you already, but logically, you should know where these items are coming from. And in fact, what's happening here is if you look at inventory, the book value of it was 60,000, and the fair market value was 80,000. A difference of 20,000. That's what this 20,000 represents. Similarly, land was over here at a book value of 40,000, and then land was given a total of 90,000, a difference of $50,000 between this 40,000 and this 90,000. Then we recognize that the building had a book value of 120, and the fair market value is 150, a difference of 30,000 that needs to be increased. And that's what this debit really stands for, is what this is sort of like a tool for us to help us remember that when we consolidate, we need to go ahead and increase the value of all of these assets that were increased because somebody came along and paid a high price for them. But because consolidation is a temporary process and none of this will eventually make it through the accounting system, and the separate companies will continue to exist separately with their book values, this really is on a pro forma basis. The consolidations that we do, they don't get recorded per se. We just determine the final balances of the consolidated group, furnish those statements, and then we ignore all of this and continue. The two companies continue separately, the parent and the subsidiary. They continue separately to do their own things throughout the year. And then the next year, again, we're going to repeat this process and increase the value of these assets. And again, the cycle repeats itself. But at this point, we just want to make sure that we're completing this consolidation correctly. Finally, something interesting happened with equipment. Equipment was worth $110,000, and in the fair market values that are given, it's 100,000. In other words, it dropped $10,000. So we need to reduce the value of equipment on the consolidated balance sheet by $10,000, and thus this is a credit, right? When you credit an asset, you really decrease. So here you can go ahead and put it in as a minus just for the time being. Of course, we put this goodwill in earlier, and then the sum total of all of these amounts, of course, will be the excess we had already determined. We just now identified what that excess was, and thus this chart is known as the adjustment of identifiable accounts. In the future chapters, we're going to see an addition to this chart where we'll deal with depreciation and or amortization expense. But for now, we're going to ignore all of that. And at this point, we're kind of ready to eliminate some of these entries that we need to eliminate at the consolidation date. Right. So let's get back into the elimination entries now. Basically, what we need to do is worry about this $630,000 because on the parent balance sheet, what we're gonna see is investment in Downs 630,000. Right, this is the date of acquisition, so nothing else has transpired, and all we have is $630,000 as an investment in Downs. What we want to do in consolidation process is we want to eliminate that amount for investment in Downs, and we want to absorb all of the net assets of the acquiree or the subsidiary, um, up to 80%, because that's our ownership share, and then deal with the NCI separately. But complicating this entire process is the fact that we have goodwill and appreciation built into this overall scenario. So what we have to do is go step by step here, and we'll do that. Starting off with the 630,000, we know, if you add, by the way, these two amounts up, the sum total is 630,000. We know that. So what we're gonna do is we're gonna start chipping away at this. Let's first get rid of the book value, the 272,000 amount, because remember, the investment in Downs Company is currently at 630. So if we chip away at the book value first, 272,000, that will be this portion of it. That's what we're going to eliminate initially, and you'll see it come together towards the end. So for now, just trust me on this, that you want to get rid of the book value first. So we'll make that elimination entry 1 EL, and we'll reduce the investment in Downs by that amount. The debit side of this recognizes that we are taking away 80% of the parent's control from the book value. Well, we know the book value, it's given to us up here. So so the book value of common stock for Downs, that's what we're going to get rid of, is $20,000. That's their book value. And again, I'm just gonna get myself some splits here to help me along. And so what I want to do is I want to take away 80% of the book value, for common stocks, that's 16,000, and do the same for the remaining equity accounts. So again, I want to multiply things by 0.8, so I just want to change that to the book value of paid in capital, 180,000, and I want to change the retained earnings to 140,000, and add it together. This should add up to 272, and it does. Okay, so what we've done is this pink section here, we've ripped away 80% of it from our balance sheet, and what we've received in return, or we've given up in return rather, is the investment. Right, we're eliminating our investment, as if we didn't have any investments, and rather what we're going to do is we're going to absorb the subsidiary's assets in the subsequent steps. But for now, we do need to eliminate all of this up to 80%, but we just did that pink part right now. Let's move on to the remainder. All right, so that's elimination entry 1, where debits here should reduce total equity of the subsidiary by 80%, which is the extent of the parent's control. The credit will need to remove the parent's investment by the same amount as part of the consolidation process I just kind of explained. All right, the next part of this deals with this excess of 358,000, excuse me, that the parent paid for their share, right? And if you're right now concerned about what happened to the NCI share, you'll see that down below. So right now, I want you to just ignore that, just stay focused on the parent. And we've just dealt with eliminating 272,000 worth of investment. Let's get rid of this other 358,000 next. So we're gonna go ahead and work on that 358,000 next, the excess. And right off the bat, I just want you to go ahead and put that in here. Because ultimately what we're trying to do is we're trying to eliminate these two amounts, because theoretically that's what, or 80% of that is what the parent company owns. I want to get rid of it, absorb the 80% of the or 100% of the value or net assets of the subsidiary, and then give a portion to NCI's share. And we'll see all of that in the subsequent discussion of the worksheet. But for now, let's deal with this other amount that we haven't dealt with, the 358,000. Right off the bat, that would be a reduction in the investment in Downs company account. Again, if you were to add these two reductions, right, the 272 in the from the prior entry and the 358 from this entry, this should really be the entire investment from the parent's point of view. All right, so let's see if we can figure this out. We know now that from our determination and distribution schedule, we know that, from our adjustment of an identifiable accounts schedule, we know that we need to increase inventory by $20,000. So let's in fact go ahead and put that up here on the screen. Land would increase by 50,000. Building is an increase of 30,000. Goodwill, we determined way back here, was an increase of 357,000. And we know that equipment went down by 10,000, right? So here you want to credit that amount, and it's already a minus, so I'm just going to put another minus, so that'll be a credit of 10,000. So when we record this entry, it'll reduce the equipment by 10,000, right, on the general ledger. So basically, we'll have a situation where the building's cost was previously, equipment's cost was 110,000. We reduced it via this entry down here by 10,000, and then it will reflect the market value of 100,000 automatically after this entry is done. This last component is pretty much a plug, which recognizes that debits and credits should equal each other. And so basically all I did was I went blue minus red, which is 89,500. What does that mean? That means that when the parent paid excess amounts over and above the fair market value of, not even the fair market, the book value of the subsidiary's assets, net assets, or book value, it recognizes that there was this NCI's share, non-controlling interest share, that increased in value as well. And we figured that out up here, 89,500, by the way. So we want to give them this extra cash or value, extra value through this entry. We recognize that their retained earnings value has increased because of this excess. Imagine you had a car and you sold it, and somehow you received more money for it. And part of that car was, say, owned by a friend of yours. So when this new buyer comes along and gives you an additional amount over and above what you think your car is worth, then that partner of yours or friend of yours or whatever that is part to this deal will also benefit. And that's what this NCI's increased share recognizes, 89,500. And we kind of already knew that up here, but now we're kind of explaining how this will impact the accounting system. Okay, so we have now finished distributing all of these excess amounts to these assets, reduced them when needed, removed the parent's investment, or the remainder of it rather. So now we've dealt with all $630,000 worth of investment. And finally, we've also ensured that the non-controlling interests retained earning increased by the excess that the parent had paid. The next step is to pretty much record this in a worksheet below. And I know it sounds a bit daunting and difficult, but as you go through it, I'm sure you'll realize it's not rocket science, and something you can handle. So here, we're going to pretty much record everything that we see here in the journal entry forms format. So all of these items we're going to record in the investment column here, right? So they give us the trial balances of Roland and Downs, and we can confirm that these are the correct amounts by looking at the fact that we have these amounts up here, and they kind of mimic everything down here. Um, just note that something new that we've learned in these chapters is that we actually put in all of the credit amounts as a negative. And what this does for us is that when we have a sum total of all of the items on a chart of accounts, or rather the trial balance, and if the sum total is zero, that tells us that we're on the right track, in that all of the positives are equal to all of the negatives, and all the positives are simply debits, and all of the negatives are basically credits. So all of the debits minus credits in fact is zero, thus they're all equal to each other. Similarly here, and you'll remember these three amounts that we kind of went through in the previous entry. So these are just the same thing here for Downs. These are all book values. And now we're going to come along and we're going to record the investment that was made on this fateful day by the parent. All right, so we've already done the hard work. Now we're just plugging in the items, and so this is something you can handle. I promise you. Just stay with me. Okay, so initially we have a debit to investment in Downs, which is this right here. This recognizes that we have investment we made in Downs. So let's go ahead and record that right away. The other side of this gave us an increase to Roland common stock. In other words, they're the ones that issued common stock, as I previously explained. And I don't feel like typing anymore, so I'm just going to do that. And what else? Well, we also had this acquisition situation. So when cash was paid, that's a reduction or a credit to cash, which is a current asset. So I'm just going to go ahead and write that there as a credit. And then this other 40,000 is an expense. You'll notice there's no expense or revenue items here. It's because what we're doing is we are looking at the impact of this consolidation, and the ultimate impact of an expense is a reduction in retained earnings. So from the point of view of the parent company, this is simply a reduction or a debit to retained earnings. This was a tricky bit because we normally record expenses and they filter through the closing process and eventually update the retained earnings. But here in consolidations, we're just doing it in one fell swoop. And that's why we waited till advanced accounting to show some of these concepts to you. And hopefully by now you'll recognize that having an expense simply is a reduction of retained earnings. All right, so that foots for us. And again, we can double click on these formulas to ensure that everything is where it needs to be. That is perfect. Let's move on. All right, so we've recorded the investment, or we are pretending to record the investment for consolidation purposes. And subsequent to this date, we're going to just pretend these entries in the investment column and in the elimination column didn't post, because we won't post them, and the two companies will continue to exist separately. But for this moment, we want to be able to provide a consolidated idea of what the investments were worth to the parent company in just one statement. Thus, the name Consolidated Statements. All right, so the first set of these entries are dealt with. Let's see if there are other entries. You betcha. So this is where we start working on the elimination entries. Now we're going to be recording the elimination entries, and we've already done the hard work up here, so there isn't a lot of analysis left for us. We just need to copy and paste a lot of these items. All right, so the easiest thing to start with is this investment that we're crediting from Roland's point of view. And again, ultimately, this is all going to be combined into one, so it doesn't really matter. But just for the sake of clarity, we're going to be looking at the EL transaction first, specifically the investment account. And as you know, we need two lines for it because we're dealing with the 272 and the 387 or whatever that amount was separately. So in this credit, I want to just simply put in 272,000 as part of that elimination. And of course, this will also reduce any stake we had in their equity at 16,000 and so on and so forth. So let's do that here as part of the elimination entry. They kind of already give us the roadmap where the EL entries should go. And again, this is common stock for downs, paid in capital, and retained earnings all for downs, and that's exactly what we see up here is what we're going to reduce. And so that goes down there, and I'm just going to go ahead and copy this down below just because I note that the remainder is pretty much similar from here to here. All right, so what we've done so far is we've gotten rid of the book value, this pink shaded part, but only 80% of it, right? Because 80% of it is owned by the parent. The remainder 20% we'll see that down here in the NCI share. But for now, we've just dealt with that 80% here. Let's see what else we have left. We're also going to want to get rid of this second investment, 358,000. It's labeled as D again, part of the distribution and determination schedule, and so that is a 358,000 we want to invoke, and then D1, D2, D3, boom, 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 and again, this is what this all represents, right? The debits D1, D2, D3, inventory, land, and building, inventory, land, and building. So that's what those D1, 2, and 3 stands for. And again, it's pretty straightforward here. So I'm going to copy those items. Brilliant. And we just want to copy the values. I don't know. There we go. Right. And so now we've dealt with those three items. Let's go ahead and give this company their fair share of goodwill as well. And goodwill is row 135. That's D5. Boom. 3D5. So it kind of helps us to know where things are, these labels. And so I kind of like them being there. And we recognize that equipment was an item that was reduced in value from what it was. So we want to credit the equipment by 10,000. And because it's labeled credit, I don't need to go minus here. You know what I mean? Here in this scenario, these items were actually not divided between debits and credits. That's why the negative was necessary, but here it's not. And finally, we have a difference here of this 89,000 that belongs to the non-controlling interest. In other words, they received 89,500 in an appreciation because somebody came along and purchased a company and gave the company more money than it was worth. 20% of that was 89,500. How do we know? Because we determined that up here. This 340, this excess of 447,500, 20% of that was 89.5 is what the NCI value increased by, right? So that's that amount right there. Incidentally, that brings us to a correct amount for the elimination and adjustment entry, and now we don't really even need to go back to this top part. We can just focus in on here because all the hard work's been done. All right, welcome back. So Um, we want to go ahead and take a look at the NCI share now. We know that we have taken away 80% of these amounts. So, really, what remains is the NCI's share, right? If this shaded part represents 100% of Down's equity, and it does, and we have taken away 80% of those amounts here, then what remains must be the 20% share that is owned by non controlling interest. So here we just need to simply identify what that is. And because these accounts are credit accounts, we need to end up on the credit side here, keeping in mind that the credits were reduced by these debits here, right, in the same row. So here I'm just going to go equal this minus this, but the problem is this was already negative, so to make that a positive I'll need to go minus that, and this is something we needed to subtract, so that should be it. Yep, 4,000, right? 4,000 plus 16,000 is in fact 20, so we're good there. And really I can just copy that down below, and sure enough that's correct. All right, so we gave them this additional benefit. This is what remains, excuse me, let me rephrase that. This is what remains out of the subsidiaries' equity, and we get, that's the balance that we can chalk up to NCI's share. We also recognize that the non-controlling interest increased by this amount. And so if we were to absorb everything and say, okay, the NCI's share is what remains in subsidiaries' equity, the 20%, and whatever the appreciation was given to them for a total of 157,500, does that make sense? Is that the NCI's share? If you go back up here, you'll notice the 157,500 is the fair value of subsidiary. Right. So now we have taken care of everything that was owned by NCI, and we've given them the 20% that remained behind of the book value, and then 20% of the appreciation or excess, 89.5, and the total of the two is really what the NCI is worth. The remainder of this was already kind of done for you, I believe, just because I put in the formulas. But all we're really doing here in this last section, right? All we're doing here right now is just adding everything across the board, right? So if I go here, what we want to do is we want to absorb all of the subsidiary assets and their liabilities, and we should be done with things, right? So if you go 50,000 plus 70,000 minus a credit of 40,000, that's 120,000 here, minus 40,000, it should be 80,000 debit, and that's really what the formula calls for, right? What happens to the investment account? Well, investment, if you recall, was purchased for 630,000 in Downs, and we dealt with those two items here. We eliminated it altogether, and the investment account is now zero. Why do we do this? Because imagine a parent has lots and lots of investments, and half of your balance sheet asset side is filled with investments in X, investments in Y, investment in D company, investment in Z company, whatever, right? Bunch of investments. That is sort of confusing to the end user. And so what we want to do is we just want to absorb all of that net assets of these companies and get rid of this investment account to make it easier for the end user to realize, hey, I don't need to worry about the underlying investments here. What I need to worry about is what the assets, net assets are worth, excuse me. All right, moving on to this next item, inventory. Again, we're simply just adding the previous balances together. We're absorbing all of the net assets of the subsidiary as if it doesn't exist. It's part of our consolidated group. Anytime you own 50% or more of a subsidiary, you need to consolidate. And so that's 120 plus 60 minus, again, 20. That's, excuse me, it's a debit, so plus 20. So all of those items added together. Land similarly added everything together. What else we have? Building, everything added together, and finally equipment, everything added together minus that amount that we subtracted, right? So that's the uh, balance of Roland's equipment plus 100% of the Downs equipment minus any depreciation here. It's not really depreciation, actually. It's just a reduction in value um, based on a gain or loss situation, more like a loss. But anyway, that's the final balance for the equipment account. We also recognize that there is now a goodwill that'll show up on the consolidated group's balance sheet, which will not show on separate statements, as is true with the rest of these items that were increased in value. And again, goodwill is something that can only be generated upon a purchase of a company. So this really does belong only on the consolidated statements. It will not show up on the individual statements at all. We have current liabilities, which I think was pretty straightforward. Again, those are the two amounts. I put in an extra minus just so I could not have like double negatives here. So it's really 240,000 because we're just putting them together. And the what happened to the Downs equity, right? So Down Company's equity was this right here. We took away 80% of it by a debit here. We leave as a credit these amounts for the NCI's share. But again, we are not going to put that in here at all because we don't want on our consolidated balance sheet anything that pertains to the equity of NCI's share. We just want to put them all down here in a corner because we don't really care about the NCI's share, and we make no attempt to distinguish or characterize the components within the non-controlling interest. We just want it identified and left alone because as a consolidated group, we could care less about the NCI's share. Okay, so we're going to just go ahead and get rid of all of that, not put it in here, and instead put it in this cell here, but we'll get to it in just a minute. Then we have the common stock of Roland, the paid-in capital, and the retained earning bits. And again, those were the previous balances augmented by absorbing the equity of the subsidiary, which enhances our equity, and then a reduction of this 40,000 in our retained earnings. That was part of that acquisition cost, right? Nothing else transpired. So in fact, now we are better off in our equity than we were previously because now we have augmented our equity with our subsidiary's equity. And what we've done simultaneously is we've shown the portion of our equity that belongs to NCI. So the NCI then is simply the addition of all of the credits for NCI, and we just put it in one line. Again, theoretically, we can segregate the NCI into its various components, but again, our focus is not what their evaluation is worth. Our focus is what our valuation is worth if we didn't have investments in Downs as an account. I'm certain you could have done this on your own, but I know it does seem a little scary in the beginning. We'll work more on these worksheets down the road, and you'll get better at them. But I hope that this video was able to help you folks out. And again, just keep writing to me, keep emailing me, and if it helps, I will certainly do more videos like this. Thank you again for the time you took to listen to all of this lecture, and again, best of luck.